Over the last 2 weeks, the biggest players in traditional finance pulled nearly $4 billion out of digital asset ETFs.
Yeah, almost $4 billion.
Right. But at the exact same time, these legacy giants are spending billions more to build permanent 24/7 trading infrastructure for those exact same assets. So why build a massive vault for something you're currently dumping?
Exactly. It seems completely contradictory.
Welcome to today's deep dive. We are taking a strictly analytical look at this structural shift, figuring out what 12 straight days of ETF outflows actually mean for market sentiment, and really how this sudden capital flight connects directly to the explosive growth we're seeing in traditional equities.
The scale of this move is, well, it's what really demands our attention here. We aren't just looking at a mild pullback. Over a single 24-hour cycle, we saw $110 billion in total valuation completely wiped out from the ecosystem.
Wow, 110 billion just gone.
It's just gone. And that triggered a massive spike in market anxiety. I mean, spot prices broke right through the $69,000 support floor and bottomed out near 65,400.
Which makes perfect sense why the volatility indexes flashed red.
Right. We saw a 20% surge in 30-day implied volatility. The BVIV index hit 46.45.
And a huge driver of that fear was seeing that massive exodus from the ETFs, right? Like 12 consecutive trading sessions of net outflows totaling $3.97 billion.
Yeah, that's massive.
BlackRock's IBIT alone saw over $388 million in single-day redemptions.
Which pushed the 2026 year-to-date flows completely negative.
It's like a massive pressure valve being released after everyone assumed the intake was permanent. So does this wipeout mean Wall Street is permanently rejecting the asset class, or is this just a temporary tactical retreat?
Well, they aren't rejecting it on a philosophical level. They're really just doing math. Fiduciary allocators, basically the wealth managers, are executing what's called an equity yield substitution.
Let's break that down for the listener. What does that substitution actually look like in practice?
Think of institutional capital like water flowing down a mountain. It doesn't have any emotional loyalty to a specific stream, right? It just takes the path of least resistance to the ocean.
And in finance, the ocean is the highest yield.
Exactly, the highest, safest yield. Right now, traditional stocks, like the S&P 500, are hitting record highs. The traditional market capitalization just pushed up to $69 trillion.
Wow.
Yeah. Digital assets, at least in the spot market, don't offer that kind of reliable yield. So wealth managers simply redirected the flow. Their algorithms pulled capital out of zero-yield digital assets to chase the momentum of expanding traditional equities.
That makes perfect sense. They're just following the momentum. But moving that much water out of the stream has consequences. By abruptly pivoting back to traditional equities, they completely drain the buying power in the digital spot market.
Which triggers a violent chain reaction. When you remove the buyers in a heavily leveraged ecosystem, the price drops. That sudden drop forced the automatic liquidation of over $400 million in unhedged long contracts.
$400 million! Ouch!
Yeah, meaning traders who bet the price would go up without protecting their downside had their positions forcibly closed by the exchanges. That forced selling drops the price even further.
Which creates a staggering imbalance.
Right. We ended up with a 22-to-1 short-to-long ratio. That is $10.89 billion in shorts versus just $486 million in longs.
Wait, but that completely contradicts the other half of the story here.
How so?
Well, if sentiment is so incredibly poor that the spot market is a ghost town and everyone's shorting the asset, why on earth is Charles Schwab suddenly rolling out continuous 24/7 crypto futures access for its $12.61 trillion client base? Good. And regulators just approved onshore perpetual futures. Like, if everyone is running for the exits, why are they spending capital to build a permanent 24/7 door?
Because you have to separate short-term market fear from long-term structural integration. Wealth managers are draining the spot market today because their fiduciary duty tells them traditional equities are outperforming right now. That's the short game.
Right.
Schwab building continuous, 24/7 futures plumbing. That's the long game. Wall Street institutions don't actually care if the spot price goes up or down.
They just want to be the toll booth operators.
You hit the nail on the head. They are removing weekend execution risks and building the rails for permanent institutional-grade trading so they can collect fees regardless of market direction.
So what does this all mean for you listening? It means institutional capital is utterly ruthless and pragmatic.
Very pragmatic.
It will happily drain spot ETFs today to chase stock market yields, while simultaneously laying down the complex 24/7 derivatives plumbing for tomorrow.
Which leaves us with a pretty fascinating question to chew on.
Right. If traditional finance is building these massive 24/7 derivatives networks while starving the actual spot market of capital.
Are we approaching a future where digital asset prices are completely dictated by paper contracts rather than the underlying asset itself?
Exactly. Keep that in mind as you watch the charts this week.